We're talking about the future of the U.S. dollar and the euro, given the situation in Greece and in Europe. My guests are Douglas Borthwick of Faros Trading. Also with us, Jim Rickards of Tangent Capital. Jim, we were just talking during the break about diversification, this idea that the euro will increase in value against the U.S. dollar. Bring in the U.S. Federal Reserve and the idea that people believe, and many people have been accurate if you take a look at the returns, that buying U.S. Treasuries is the way to diversify your risk because you're getting out of maybe riskier assets like stocks or corporate bonds. But if you take a look at the U.S. government and their issuance of Treasuries, you say maybe that's not the best thing to de-risk the portfolio.
Well, it depends on what the rest of the portfolio consists of. It's clearly China, which is the biggest external holder of U.S. Treasuries in the world, is overinvested, overallocated, if you wanted to put it that way, into U.S. Treasuries. So they need to diversify, as Doug was saying in the last segment. So what are they doing? Well, there are only so many euros. Actually, there aren't as many euro investable assets as you might think, but they're clearly getting into the euro. That's a source of strength. But they're also getting into commodities. As you know, they're buying mines all over the world. They're even buying gold mines and smelting the gold and shipping it directly to Shanghai, bypassing the London market to minimize the market impact on their gold purchases. So they're doing a lot of, they're stripping their own gold mines as fast as they can. They've become the largest gold producer in the world. So I mean, there's a gold story there, but it's really about getting out of the dollar.
I didn't even ask you anything about gold and you went there. I love it. No, go ahead.
You asked about the dollar, Pimm, and it's a very good...
Do you think it's connected? Because I know that you've also written about the fact that you think that the U.S. dollar ought to be connected to gold.
I think that's one way to stabilize the situation. I mean, gold is not my first choice. I would like to see King Dollar. I would like to see Volcker and Reagan, Reagan sort of come back to life and Volcker get back into public office. And their policy of higher interest rates and lower taxes was a tonic for the dollar and very good for the U.S. economy. So I'd like to see something like that. But I don't see it. I have to, you have to take the policy as it comes. I'm not in charge of policy. The policy I see is clearly a weaker dollar. It's clearly what Bernanke and Geithner. The president said in his 2010 State of the Union address, he wants to double U.S. exports in 5 years. Well, we're not going to get twice as smart or twice as productive. The only way you can double exports is by trashing the dollar, and that's been U.S. public policy at least since 2010, probably 2009. So I don't blame the Chinese for getting out as fast as they can.
Doug Borthwick, you and I spoke about emerging markets a couple weeks ago when the dollar was strengthening, and that's not good for U.S. companies that do business outside.
Well, it's terrible for U.S. companies doing business outside. Obviously, a stronger dollar means that the good costs more for others to buy. Going back to something that Jim just said, though, at the start of the year in 2011, we said, there's two trades that we really like that we think people should put on for their portfolio for 2011, and it's really is what are Asian central banks short. They're short gold relative to the Western world, and they're short euros. So we said buy euros and buy gold. That trade's up 30% this year. And it really, you're really just following, essentially you're front-running central banks around the world and doing that trade. And to us, it makes perfect sense.
You still like the trade? You still want to be long euros? You still want to be long gold?
Of course. But not only that, I think that something else that I wanted to discuss was last year we also put together a paper that talked about we expected the U.S. dollar would weaken by 40% over the next 5 years, based on how we saw dollar China moving from 2005 to 2008. That would put around an average slope of, I think it was like 7.83% of the dollar index. And that's exactly what we've seen since June 21st, when China in 2010 went back into flexibility. You've seen the dollar index move 7.83%. And I don't think it's luck. I think that we're onto something here, that the dollar is on this sort of path, which China describes as being a gradual appreciation. The U.S. is also in a gradual depreciation of the dollar. It has its hiccups, but we know A is here. We know that B is going to be down here for the dollar. And in between, you're going to have this noise.
Jim, why do so many people seemingly cling to the idea, and we were just talking about this with Charles Calamirez, that there's this connection between whatever the bailout plan is for Greece and whatever the ECB does, and they connect that with the value of the euro. Do we have to learn to look at it in a different way?
I think you do, and I think this has been a major source of confusion. You have the bonds, you have the banks, and you have the currency. There are three different things. The bonds are toast. I mean, these bonds are worth 60, 50, 40 cents on the dollar. I wouldn't touch a euro sovereign bond unless you're just an outright speculator. I think the banks are toast. Not all of them, but most of them. I think those bank stocks are going to go to zero. And remember, to a great extent, as you know, the banks own the bonds, so the bonds go down.
That's what they're using as collateral.
But that doesn't mean the currency is toast. I think the currency is going to get stronger, exactly as Doug said. I mean, I take Enron, for example. Enron defaulted on tens of billions of dollars of obligations. It wasn't the end of the dollar. It was just the end of those bonds. The other thing about China coming in, capital flows from China to Europe, China is not just an economic player. It's all fine to have the Professor Calamirez's models, and he's brilliant in that respect, but they're a geopolitical player. They want infrastructure. They want to buy ports, highway systems, airports. They want technology. They want military technology that the U.S. won't sell them. So they're using, are they going to rescue the euro? Yes, they will, but there's a very high price to pay. They're going to get access to sensitive technology, critical infrastructure, and other things in Europe that they have been denied. And they're not fools. They say, here's the money, but we want a lot of access. And they're going to get it. So there's a geopolitical aspect to this.
A different kind of sovereign wealth fund.
Correct. It's a sovereign strategic fund, if you will. And they use SAFE, the State Administration of Foreign Exchange, CIC. These are all instruments of government policy. I have to remind people this is still a communist dictatorship. It may resemble a free market, but it's really a neo-mercantilist or state capitalist model. But the Central Committee of the Communist Party still runs the show.
Very provocative. Thank you very much. Jim Rickards joining us from Tangent Capital. And I want to thank, of course, Doug Borthwick joining us from Faros Trading. Thanks very much.